recipes for technical trading success in Cook's Kitchen.
So is Red October over already? Not so fast. This correction is just getting rolling. Here was the piece I did last week. Hunt for a Red October, stocks to buy during the correction. And I gave you some ideas. Just take a look at them. Here they are, my top 7 buy list that I gave my Taser members early last week. There you go. NVIDIA around 180, Square around 220. The trade desk under 65. And the only thing that really triggered for sure was Square. Square made a low this week of 223 on Monday and popped hard on Tuesday, on turnaround Tuesday, trading 238 right now. So that was a good scoop for Square down there if you're a Square bull like I am. The trade desk, it's looking tough. I mean, it won't go below 65. And like I said, I thought Bailey Gifford's on the bid under 70. I think they're still buying there. Qualcomm, you're getting a shot there. AMD, not so much. Shopify, let's look at the Shopify chart. Well, I got the NASDAQ up here right now. So look at, everybody thinks that, turnaround Tuesday was this great reversal. It was not a reversal. There was no volume. And look at the candle body closed inside of Monday's body. And here you are we can't even touch yesterday's highs. And it's getting sold already. And the S&P looks even worse. There it is. Big red for the S&P. So I just want to show you Shopify real quick. I said, buy 1240, 1280. You got kind of a shot on Monday. This low was like 1286. And it's looking tough. So all the things, when I say my blue chip growth tech, when I say NVIDIA, Square, the trade desk, Shopify, AMD, these stocks are holding up and you're barely getting a chance to buy them, but I think you still will. So keep your buy targets ready. Have some orders in for things that you're very confident about. If you'd had an order in Square at 220, you wouldn't have gotten them. But, if you were fast, you probably could have grabbed some, 225s, 226s. It closed at 226 on Monday and then just ramped, so one of the stronger stocks recovering among strong big cap growth tech. All right, let's look at breadth. It's time to look at breadth and where I'm calling a bottom. So I said the correction is not done yet. Let's look at some different things. I'm just going to jump around here. Here's a nice tame look at NASDAQ new highs minus new lows. So net on the day, were there new highs or new lows and how many? And pretty tame looking, right? It doesn't look scary at all. It doesn't look like, and this is at least a 2-year chart. It doesn't look like the Corona crash here. We've barely done any damage for this 7% correction. So it's sort of a stealth correction. It's catching people off guard, but it's not catching us off guard because I told you, we were getting ready for this in early September, and the gaps that trap are alive and well. Let's take another look at breadth via stocks above the 200-day moving average. Now, this is the NASDAQ composite in the black. This is the full NASDAQ index, which has been down to 14.2. We haven't been below 14.5 yet in the NASDAQ 100. And then the green line is the percentage of stocks above the 200-day moving average, but it's just for the NASDAQ 100. I couldn't get one for the composite. So what do we got here? We got an index, holding up pretty good, and you see the breakdown. We're down to, 50%, 51% of NASDAQ 100 stocks are above their 200-day moving average. I think this will get worse. So I don't think we've seen the bottom. We're barely past one standard deviation. 2 standard deviations would be 41%. So this tells me we go lower. That's just my view of it. All right, let's take a look at. Oh, by the way, I want to show you the index indicators website. These guys have been on a free model, just advertising to pay their bills for years. For 13 years, they've done it. And they're throwing in the towel on that, and they made a new site that is going to be subscription based. Now, I've used them for years to look at market breadth. So really, really a good site, good tools. You see up here, you can select a stock index, then you can compare it to an indicator, movement, breadth, put call, volatility, and they've got. Here, I'll just show you. Look at all the different breadth indicators you can get on. Percentage of stocks above every moving average for every index, except the NASDAQ composite. They just use the NASDAQ 100, as I mostly do for a proxy. There's the S&P 500, all the indicators you get. 20-day lows, 20-day highs, 20-day highs minus lows. A lot of cool stuff here. And at the new site, which is called, it's down here, marketcharts.com, they're only charging $19 a month. And I think they have a yearly deal too. So if you like to look at breadth and you're an index trader and you just, you can cancel anytime. Like I'd use it. I would definitely use it during correction time because you need these breadth indicators. Now I'm going to show you my favorite breadth indicator to mark a capitulation low. We've not seen capitulation yet. There's too many weak hands, too many easy money speculators out there. I'll show you my favorite capitulation indicator coming up right after we let's look at the S&P 500 and the percentage of stocks above the 200-day moving average. Again, what's the mean? The mean is 66.5%. That's the mean for the S&P 500. And this is going back, this is a good 2-year chart here. So we barely broke through that. So we could easily go to one standard deviation of, 45 to 40% of stocks above their 200-day moving average on the S&P. So another thing that tells me the correction's not over. All right. My favorite capitulation indicator is the S&P 1500 new highs minus new lows expressed as a percent. You can look it up on stockcharts.com, put a $sign in, SUP, HLP. I've used this for years to call capitulation bottoms. And what is the S&P 1500? Well, obviously it's the big cap 500 index, the mid cap 400 index, and the small cap 600 index combined is 1,500 stocks. So you're really looking at the bulk of the market here. In all caps, right? All different cap ranges. So what does this tell you? Well, we haven't seen any big selling. So back here, late 2018, that's the last nasty correction we had. That was really quick that December. Now, is this market going to hold on? Are we going to get a bad Q4 like we did in 2018? Remember, 2018 was tapering and rising rates. I mean, the Fed was hiking. They said they were going to hike 4 more. They had just hiked in, I think, they hiked in Q4, and then they said and then the dot plot said they were going to hike 4 more times in 2019. You know what that did? That caused a yields just blew out. Yield spreads just blew out in credit markets, and so junk was just getting trashed, and it threatened the stock market. So the stock market had a tantrum on the junk yield blowout. And then the Fed said, okay, maybe we're not going to hike 4 times next year. And, the market recovered. So, we can't rule that out. Even though I'm betting on a strong Q4 for this market, if rates keep rising and the market decides, large investors are, scaling back allocations, getting cautious, and the algos can push it down and create some sort of tantrum just to get the Fed to back off, it's certainly possible we could have a repeat of that scary Q4 from 2018. But, so for now, we just have not seen the capitulation. So that's why I wanted to show you that. All right. Trend lines. Everybody's talking to me about, oh, God, we hit this trend line. We're going to hit that trend line. BS. Trend lines are useless. I did a piece 7 years ago called Trend Lines Are Mathematically Absurd. Why are they mathematically absurd? Because it's a straight line that's arbitrary. And markets are nonlinear, and markets have wild randomness. You cannot draw a straight line across billions of economic events, is my basic thesis. So I posted something on Twitter here because I found. Let's show you the video first. Stockcharts.com. Tom Bowley, excellent technical trader. I was watching a little bit of his video at minute 21 in this video. So this is October 5th. Tom Bowley. It's titled NASDAQ Leads Equities, Another Leg Lower. At minute 21, go to minute 21. He just sums up my case in like less than a minute of how arbitrary trend lines are. Where you put them depends on, you can make a bull case or you can make a bear case. And then he talks about my favorite indicator, which is just horizontal lines. Horizontal lines show price memory. So you can check that out. So I posted that on Twitter. I said, here it is. If you start watching at minute 21, Tom Bowley gives a perfect 1-minute synopsis of why I said many years ago, trend lines are mathematically absurd. And then 5 minutes later, I just saw the news about the Nobel Prize. I'll try not to play this video here. So the Nobel Prize went to 3 people in physics, or the Nobel Prize in physics went to 3 scientists who have contributed to the study of climate change. And there were 2 partners and then one guy from Italy who just studies complex systems from the atomic level to the astronomical level. But my point is that this is one of my best arguments for why trend lines are mathematically absurd in markets. Look at the complexity of nonlinear systems like weather and climate. Multidimensional, nonlinear, geometric. And then take that complexity and multiply it by an order of magnitude to understand why markets are social beasts that have wild randomness, as Benoit Mandelbrot wrote. So that's why trend lines connecting price highs and price lows are just mathematically absurd. All right, let's see. I've outlined the correction. Let's go back to the chart just to see where I think we're going. So here's the NASDAQ 100. So we've been to, what was this low Monday? This low was 14,384. So we hit the 14,500 I was targeting, but I really want to see this 14,000 because if we scrunch this up, that gets us into the April highs, double top April high resistance, and then this cluster of support in June. This is going to be real good support. And then you've got a 10% plus correction on your hands in the NASDAQ 100. And the S&P could still stave off a 10% correction. 10% correction for the S&P would be down here in this, let's say 4060 area, which coincides with the double bottom in May of 4060. Very nice. And the 200-day moving average is rising to meet 4100 right now. I don't have the 200-day on here, but the S&P could easily, trip down to 4200. That would be its 7% correction, and it doesn't need to, doesn't need a big washout like I think the NASDAQ does. All right, so that's your correction update. We'll do it again next week. Thanks for joining me in the kitchen.